We're here with Jun Hong Heng, the founder of Crescent Cove Capital. I've worked with Jun extensively when I was running my company at Vungle, and also we've tried to do some cool stuff together. We tried to set up a private equity fund, and I think you guys are probably working on that later on. But would love to learn more and educate my viewers on why they don't have to run to a venture capitalist when they need money, and also why going to a bank isn't the best solution either. So let's quickly start with an intro about what Crescent Cove Capital does. We'll take it from there.
Sure. So Crescent Cove was founded in 2016. I'm the founder. And
that's right, because we met pretty much, Jun, you actually contacted us when I was running Vungle very early on, right, when you guys had started?
Yeah, that's exactly right. And we focus on creating capital solutions for our companies. What makes us really different is we don't try to pigeonhole companies to say, hey, you will require debt, you require equity. We try to understand what is the problem first and ask the company, so if you had a choice, what would it be? Yeah. All right. So that kind of gets the conversation going, and that really helps craft the solution. All right. So this solution can be in a variety of ways. Most of the time, companies feel it is debt for the companies that come to us, right?
It's debt.
It's debt, right? And what they like about us is two things. First of all, we can be nimble, right? Meaning we can be flexible in our terms. And number two, we are we can move quickly, right? So these two things really differentiate us from the rest of the market.
So you're saying people should go to a private lender. Is that right, to categorize you guys as a private lender?
Yes.
Right, a private lender when they have a problem, or at any point in the life cycle of their company?
Yeah, at any point in the life cycle in a company. It doesn't really matter to us. We're pretty flexible. We believe we can help with capital.
So you're saying if someone's trying to start a company, would that be the appropriate time to go talk to someone like you guys, or do they have to be established?
Well, I mean, it's right now the terminology is pretty undefined in regards of what is a startup, what is an established company. In our portfolio, where companies were started 20, 30 years ago. At the same time, we have companies who have probably started about 3-4 years ago, right? But I think that's one thing. Again, we do not actually want to pigeonhole a company and say, okay, you're probably not the right fit for us right off the bat before we understand what is the situation, right? So, we like to talk to people to see how we can help. I think that's the bottom line.
Now we're going to discuss really about the private lending market overall and what it looks like. Is there a way for you to give my viewers a sort of a breakdown of what the overall market looks like when it comes to financing and specifically for startups overall when it comes to lending? How does the market break down?
Sure. So there's a few segments of the market as a startup, right? Most companies start off with a credit card. It's pretty straightforward. It's a credit card, right? If you go to a bank, and you're spending, if you go to a bank, you're not profitable yet, but you do have receivables, you do have some working capital needs. The first thing you go for is a credit card to fund some of it, right? This is the number one step. Secondly, the banks will probably say, okay, if you have some kind of history with them, they'll probably say, okay, we'll give you an accounts receivable line, right? And that would be basically
you're borrowing against the money people owe you.
Exactly, right?
Yeah, and that was a big problem for me when I was running my company. On paper, we're making so much revenue and so much profit. But in the early days, we weren't collecting the money. And suddenly you can get in severe trouble, even if you have a lot of revenue and profits, but you're not taking in money in the bank. You've got all these invoices outstanding. And so account receivables is a very important lifeline. In one industry, especially advertising, the biggest issue is working capital, where your customers perhaps take 60 days to pay you, but you have to pay your suppliers immediately or within 30 days. So that's one area of the market where obviously startups need help.
Yep.
Yep.
Yep, that's exactly right. So other than banks who do that, there are now more alternative lenders, like online platforms that can help give you this kind of working capital loans pretty quickly. But they kind of tap out around, $500,000.
$500,000.
Yep. So
Why is that? They want to reduce their risk exposure to each individual company, or is it a different reason?
It's just a segment of market they're targeting. If you're
Right.
larger than that, you probably have a more established regional bank or
Right.
that can help you out.
Yeah.
And then post that, if you're able to get that, or if you are not able to get that, the next stage is probably something called venture debt. Right?
Venture debt. Right.
So venture debt is something where it's really competing against banks. Right? Banks. Let me correct myself. Actually, banks do have a venture debt as well, and then you have funds that specialize only in venture debt. Right. So this segment specifically looks at providing debt as a form of growth capital for companies who do not want dilutive kind of financing. Right. So they're very focused on recurring revenue, growth on the revenue, so on and so forth. Right. Most of these companies do not really have collateral. Right. They do not actually have hard collateral like real estate or
anything tangible, real,
Yeah,
that
exactly.
a bank would probably be satisfied with.
Yes, and they're not cash
Yeah.
flow positive. That's important, right?
Yeah.
So most of them are betting on the enterprise value, maybe because of the recurring cash flow stream, right? Well, recurring revenues from like a customer base, so on and so forth, right? So that is another segment of market, right? And then there are guys who are like us,
Yeah.
right? We are playing in a different field where it's we don't really call it venture debt, right? Because we don't really need recurring revenue. We don't want to bet enterprise. It's a different sort of it. We can be very flexible, and we can see, okay, what do you actually need, and go from there, all right? So venture debt, if you don't have a good sponsor, not many people want to talk to you as well.
What does that mean if you don't have a good sponsor?
Like a top tier VC firm.
Right.
Right. And of course that varies on what people mean by top tier. Right. So for us it doesn't really matter.
Yeah. When we at Vungle, we actually took a $500,000 venture debt loan in the very early days with Silicon Valley Bank. One of the requirements for Silicon Valley Bank, at that time at least, was you need a top tier VC backing you. It has to be a VC that we know, and in some ways, on the back channel, they're willing to commit to invest further into your company. So we're okay to give you that loan. But that isn't available to a lot of people. A lot of my viewers here might be running a lifestyle business, and it's difficult. Banks are too difficult to work with, and venture capitalists might not understand their model. And the venture debt funds need to make sure that you're backed by top tier. What you're saying is there is a segment here that's unaddressed. We've got legitimate, valuable businesses that haven't necessarily diluted their cap table and, had a venture capitalist come in, but there are better ways to get cash in very quickly too.
Yeah, absolutely. What you say is exactly right.
So I've invested in Crescent Cove as someone who is trying to diversify. It's very important to get exposure to this segment of the market. So how are things going at Crescent Cove? What are you guys up to right now? And give me a quick update.
Good. So, for just to recap of what we do, we write checks we can write checks as small as $500,000, but checks as large as $40 million for our investments.
Yeah.
We invest mainly in TMT and consumer, meaning TMT is telecom, media, and technology, and consumer. We are based in San Francisco. Just by virtue of where we are, we see mainly high growth companies. We do not invest in real estate, commodities, or biotech for various reasons. Our sweet spot is really TMT.
So Jun, I invested in Crescent Cove for a couple of reasons. Number one, I'm a friend of yours. I've worked with you for a long time, so that's obviously how a lot of investments happen sometimes, I feel, for high net worth individuals. I like this guy, I'll put money in. I went to YC with this guy, I did a startup with this guy before, I'll put money in him. But also the other reason is genuinely I want returns, and also I want exposure to this asset class. And you guys aren't necessarily private equity. You're private lending for startups and companies, small business companies, basically. How should I be thinking about diversifying my portfolio, and how should other people who want to create a really good portfolio think about how much they should be investing as a percentage of the total portfolio into this asset class?
Well, I think it's hard to say.
Obviously, you'd want them to put 100% in.
Yeah. No. Well, I mean, it's hard to say how many percent of your portfolio. But what I can say is this, right? What we are really focused on is the lower middle market, right? And
the lower middle market.
Lower middle market, right? And that definition can really be a wide range of it, right? What Crescent Cove hopes to achieve is uncorrelated returns, meaning absolute returns, right? Regardless of what the market returns, we can talk about absolute returns.
So uncorrelated returns, important word here, and that means that independent of how the economy is doing, whether there's a recession or what's going on with the coronavirus situation or a war, unfortunately, somewhere else, absolute returns. Is that what you're trying to say?
Yes, that's correct. And the situations that we are focused on have three characteristics. One is complexity of situations. All right, typically the borrower, the potential borrower would not go to a bank. They would not be able to. Most of the banks or alternative lenders would turn them away. They're just not a good fit for any kind of these situations. Number two, these companies are niche industries, right?
Yeah.
But once again, it's really up to the person to define what is actually considered as niche. And thirdly, it's like an institutionalization, right? Most small, medium, most lower middle market companies do not have a large org chart or organizational chart, right?
Yeah.
They do not have a lot of processes. They kind of run things ad hoc, and they were growing to some kind of organization. But at the time when we get involved with them, they're just probably not like a listed Fortune 500 kind of company.
Right, understood. And how should a company think about the right time to get in contact and start building that relationship? Because in this industry, talking about startups, it's about relationships. You don't want to be going to a venture capitalist when you really need the money, and you don't want to be going to a lender, I'm assuming, when you really need the money, or are you saying, no, actually, we want you to come to us only when you need the money? How do relationships play out here?
It's just like any other kind of business, right?
Yeah.
How we do it is no different from any bank, any investment bank, any manufacturing business is trying to manufacture widgets, but you need customers to buy it, right? There's a lot of foundation building with relationships, and it just starts from there. There's really no secret sauce to it.
Got it. Any final things you want to share about the industry and any advice to people?
I would say always explore your options and give yourself enough lead time to get financing in any type of financing.
Yeah.
Right. Because when the time you need it, when you realize when you need it, it's probably too late.
Now that's a fascinating topic here. You are in a unique perspective because you probably see some horrendous situations of capital mismanagement and entrepreneurs ending up in very precarious situations with their companies. A couple of quick basic questions firstly. How much money should people have in the bank when it comes to runway? Is there a golden rule that you suggest for entrepreneurs when it comes to thinking about how many months of cash should I have before I start to really get worried about financing?
Yeah, Zain, that is an interesting question. I think there's a lot of rule of thumbs that are set up by the
MBA schools and MBA schools too.
Yeah, and, they always have like you have a 6 months,
right,
minimum runway, things like that. We don't really have that kind of perspective, right? I think we'd like to leave it with our management on how they can manage the business. Because good management always has a way to figure it out, right? And most of the management that we work with have gone through some kind of cycle already.
Gone through a cycle. What does that mean?
Meaning, when a recession, or so on and so forth.
So they're experienced.
Yeah, experienced guys on the team.
Yeah.
Right. So that's we kind of lead that with our management teams.
Management teams of the companies, like the executives,
Yep.
is what you mean.
Yep.
Yep. And what are some common mistakes you see companies making when it comes to managing their money?
Well, we have seen some terrible situations where they reach out for help way too late and they flag problems too late. Right? What we like to see is, look, we can be helpful, we can help you find solutions, but don't reach out to us at the very last minute because if we can't do the deal, we can't help you out, most likely no one else can.
Because you're the last, you're the person who's willing to overlook things, unlike banks or venture capitalists.
I would say,
and I wouldn't say overlook, but I mean more flexible. Yep.
We can be faster.
Yeah.
Right. So for most banks, it would take, maybe years to form a relationship. For most lenders, they will have some kind of process, a longer process than us. For us, because we're a smaller team, we're more nimble. If we are unable to do it within a specific time frame, it's probably unlikely that anyone else can do it.
What you can't deny is a lot of people who aren't in industry, in financing, who are executives or startup entrepreneurs running their company, really do tend to think, look, I've got loans I can take from an official bank and I've got venture capital. Both are such extremes. And the moment you say, well, you can get private lending money from somewhere, from a firm, the connotation is, well, that's going to come with a lot of strings, a lot of strings attached. And in that way, the perception is, well, maybe there'll be exorbitant interest rates and a lot of covenants. And those can be fair because you have to weigh up the risk and the reward of a deal. But there is obviously this perception that, well, hold on, what's the string attached here?
Yeah, a large part of it is really, and that's why the relationship comes into play.
Yeah.
Right. People need to be comfortable with the lender. All right. I mean, we had situations where it's like, institution comes in and it gets very heavy-handed with the company, and
like a bank comes in.
It's an alternative lender as well. Alternative lender.
Alternative lenders.
Institution,
yeah.
Right? Yeah. A big institution. They're a slice of like a big institution, and then it becomes very tricky. Because at the end, the company does not really know who they're dealing with within the firm, and there's no such comfort.
Yeah,
right?
yeah.
And then of course they actually turn away the deal. Before signing, about 2 weeks before signing, they came to us and said, hey, what do you guys think? And I was like, okay, well, we can do this. But once again, how do we get comfortable with them? We had to do work quickly, and then we had to know the company well.
Yeah.
We had to know the people well. So we had someone like LPs actually knew a lot of key people within the company. So that was helpful.
That does
help. We
help.
were comfortable with them, they were comfortable with us, so we could close it pretty quickly.
Is this option only really available, though, to people who are well connected? Because a lot of people don't have the connections. They're actually heads down running their company.
Yeah.
And unfortunately, once it's a problem, then they're out there. And at that point, it sounds like that's too late. So is the message to be proactive, take time out as a CEO, or hire someone on your team to go out and build relationships with lenders, or is this something else you're recommending?
Yeah, so I think a large part is CEOs should be running a company and focus on product. They should have someone else do it. That's a good question. So we have, with one of our portfolio companies, one of the first things we did when we started the process with them was to help them hire like a VP or senior director of finance.
Yeah.
Right, because this person knows our lingo. He's our guy. He knows exactly what's going on. And if the CEO is very focused on the product, at least this guy, or managing the company, this guy with enough knowledge of the company and of the capital markets can be out there talking to investors.
Yeah.
Right, and it can be a director of finance role, so on and so forth. This is something we can talk about actually on the video, on this director of finance role. So companies have this issue now. The question is, all right, I know I need a finance function. Do I need an FP&A guy, or do I need someone who is more focused on strategic side fundraising?
Like a CFO?
No, so most companies do not really require a CFO, right? So
Yeah.
company sizes really vary. Like we have a company that is maybe like 30 million revenue, right? Profitable, right? But they are not. They have no finance function. The CEO has been doing all the finance function.
By
Yeah,
that,
but he doesn't. He doesn't
by
really,
himself.
by
Wow.
himself. But he does not really need a CFO. So he
Yeah.
needs like a director of finance guy. Because when you hire a CFO,
Okay,
you're
but the
basically
CEO
doing
is not the one who's actually calling up customers to get the money, right? At a
Yeah.
$30 million revenue stage, I'm sure he's got a team.
He has a team. He has about 20 people. All right.
On finance, though, is what I mean.
No. He is just him. He has him and there's one FP&A person.
FP&A here being financial planning. Yeah.
Financial planning person, right? But now as he thinks this year is going to make like 60 million. He requires
Wow,
someone who does
double growth. Yeah.
Yeah, and it's hardware. So hardware does inventory cycles, right? Which is tricky. So he needs someone who can help him out on the director of finance side, right? So his board members, he has a couple of board members that have built big companies before and sold them. Was like, you need a director of finance, but now the question is, do you really need someone who's more internal facing, or you want someone who's internal and external facing as well?
Yeah, this is one of the biggest things and headaches. Biggest decision I had to make was at what point do I bring in a heavy-handed finance function and step away from that? We looked at an interim CFO option, and that worked for a short while. We had contract firms be our in-house CFO.
Yes.
But eventually we bit the bullet and we hired a very experienced CFO, and that was a life changer for us. At that point, you're not just tactically chasing money, you're thinking strategically about your options. And one thing I got to say too, I don't know if what your stance is on this, having a CFO at the table sends a clear, strong message to potential lenders. You are organized, but also you're not going to be taken for a ride. If you've got a venture capitalist and know you've got a good CFO, you're not this naive entrepreneur who's doing it for the first time. You've got a CFO here, and that CFO has done financing rounds and knows what's market and isn't market. Do you find when a company has a heavy-handed finance function that the better will run overall, or not necessarily?
I think it means that a company has grown into a different stage of maturity.
Yeah.
Right. There's probably a little bit more experience around it. But I remember you mentioning when you guys were running Vungle initially, you guys felt that you had gotten better terms. Certainly if you have had someone who knew the market, it would have been different.
Oh man, we got taken to the cleaners with the terms we raised for our first round. If we had someone experienced, there's no way we would have signed that, but it worked out in the end.
Congrats, congrats once again. I think the more practical part, other than getting the best terms on the financing, is really how you can help the CEO shape their thinking, not just strategically, not just the product side, not just management, but really be the right-hand man, right? Especially when you're not yet profitable or close to profit, you really need someone to help say, all right, this is kind of the allocation of resources that we should be doing within a company. This is how we should allocate it. This is where our financial projections look like. Number two, but able to communicate this plan to outside investors or potential investors, right? And take the burden off the CEO, right? So this is something where we see pretty common, right? It's usually a decision that a CEO has to make whether, all right, is this finance person going to be internal facing or external facing, right? It's best that this person can do both, and it's hard to find.
That's a rare, trying to find someone like that is very difficult for sure. And also thinking about the experience level. Do you hire someone young who,
Exactly.
I don't mean to say young in that way, but I mean inexperienced,
Yes.
who is trying to get that CFO title and is perhaps a VP or a director of finance, or do you hire someone heavy-handed, whether he or she has run public companies before or whatever?
Right. Yeah, so we have seen this this life cycle as well, where it's the skill set you're getting. It's a little bit unsimilar, a bit dissimilar with someone who's more experienced and and less experienced, right?
Yeah.
A more experienced person would be less inclined to be hustling out there, all right? As someone who's less experienced would probably want to spend more time on the road. I mean, there are these little things that actually make a difference on how it would affect your company.
Yeah, absolutely. I find having an important, or it's important to have an executive team around you and a right-hand man or woman who can be your executor, but also help you think about the vision and complement your weaknesses. And CFO is one of those roles. I felt that you get that caliber of person. You know, when Vungle started to reach multi-$100 million revenues, I was very glad, in fact, that I hired a CFO earlier than perhaps needed. At that time, our revenue was perhaps less than 30 million when we started to think about getting a CFO. But I'm so glad we had that CFO because they allowed the foundation to take place.
Agree.
You know,
Yeah.
Great. Well, Jun, I want to thank you for having an awesome conversation. This is Jun from Crescent Cove Capital, and thank you very much.
Thanks, Zain. Thank you.
Cool.
Congrats again on the exit.
Thank you.